And good afternoon, ladies and gentlemen. So let's jump right in the presentation. Obviously, our typical disclaimer. We won't go through that. I think you've probably added all today anyway. Let's jump to the first slide. Maybe there are people that are less familiar with the Bloom Lake project or the champion story. So maybe as a high-level introduction, I think it's important to mention Bloom Lake is right next to Vermont in Quebec, which is a top-tier jurisdiction for the mining industry. It's also in a jurisdiction that has seen mining operations, especially iron ore mining operations, since the 50s. It's the second largest hub of high-grade export globally. And we'll see it later on, but there's plenty of feature in that region that makes mining a successful industry. The project was originally developed by a company called Consolidated Thompson in 2009, and it was later acquired by Cliffs, a company from the United States, in 2011. Unfortunately, Cliffs in 2014, with the downturn, went bankrupt. They filed for bankruptcy at the end of the year. The operations stopped, and then the CCAA proceedings began. Champion in 2016 acquired the project for $10 million, and keep that in mind. I think that's important when we'll talk about the investments that were made on this site. And we have invested close to $300 million in 2017. Prior to restarting the operations, main focus being to improve everything that was related to environment, the way we manage water, the way we manage tailings. And it was also intended to drastically reduce our operating costs, which was what in fact hurt the previous owner and got them to fall into bankruptcy. So we did that. We did these improvements. We started the operations at the beginning of 2018, and we can now operate since then at cash operating costs that are close to half what they were before. And I'll show you later on in the presentation, but that has been done in a structural way. So that's something that will be stable in the future. Our nameplate capacity is 7.4 million tons a year. We'll talk about it a bit later on, and I'll show you what happened regarding this. At very high level, last year, our last fiscal year, about $1.3 billion of revenues, and EBITDA slightly over 800. And obviously, if you're following the iron ore market, very positive pricing last year of about $127 a ton. Now it's much higher than that, so story remains positive on this front for sure. If we jump to next slide, unfortunately, it's tough to do a presentation this year without talking about COVID. We typically make sure to have some sort of a health and safety a portion in each presentation, so I think it was indicated today to talk about COVID. One thing I'd like to highlight about that, because I mean, different regions of the world have had different, let's say, experience with COVID. Quebec was hit quite hard last fall, in the fall of 2020. The situation was difficult. The government imposed a massive shutdown on all the industry with a lot of work and the demonstration that we could keep our operations going safely. We've managed to convince the authorities to let the operations run in Bloom Lake. So we had the chance or opportunity not to stop. We had to slow down a bit, but we remained in operation. And one of the things that we're quite proud of is our screening lab. So in a very short period of time, we've been able to set up a full-scale screening lab, allowing us to systematically screen all of our workers showing to site, because our site is fly in, fly out. So most of our workforce comes by plane for a 2 weeks shift. So it was very important for us to be able to operate safely. That's one of our key priority. And this lab was key to this success. So very proud of the team that put that together, and it's still in operations today. Hopefully the measures and then COVID is slowly phasing away. In Quebec, things are getting much better, but still it's something we wanted to highlight. It's also very important for us to touch base today on the environment. Champion's key focus right now is to work on being a solution at the decarbonization of the steel industry. For those who wouldn't know, steel accounts for about 10% of global emissions. Mainly the emissions are related to processes that are downstream what we do at Bloom Lake, and we'll touch base later on this. But what's very important to highlight here is that we're in a very good position at Bloom Lake to play a role in the decarbonization of the steel industry. First of all, we have a product of a very high purity, but also we benefit from infrastructures in Quebec, especially on the electrical side, that are 100% renewable. So in Quebec, 99.9% of our electricity comes from hydro dams that is considered renewable energy. If we look at the chart at the top right, well, what we see here is our CO2 emission intensity per ton produced compared to other peers in the industry. So it's quite obvious to see we're well within the first quartile. If we look strictly at what we do at the mine site, which we'll call Scope 1, if I refer to it later on. And if you look at the chart at the bottom left, well, that's our Scope 3 emissions. So that's considering shipping and all of the other downstream interventions or steps before the product reaches its final destination. So both ways we compare it, we see that we're very well positioned compared to our peers. And that's for two reasons, again. Well, renewable energy is one for sure, but the fact that when we account for the high grade or the high purity of our material, it drastically shifts Champion on the left on this chart. And we'll explain it a bit later on, but just keep that in mind, that's our positioning right now compared to other peers. I also mentioned there, and we'll see it later, we have the ability at Bloom Lake to produce a very high purity material. Right now, what we do is what we call a 66% Fe, meaning that we have 66% of iron units in the product that we sell. Last year, we've demonstrated we could reach grades of about 67.5, close to 68. And I'll show you later why this is important. Especially if we consider the customer base and the processes that will be using this high-grade material. Jumping to next slide. If you look on the top left corner, and I think we wanted to do a very high level breakdown of the market, and I'm sure you appreciate that the iron ore market is much more complex than this, but at high level, what we've seen in the past years is a constantly growing demand for steel. Steel is a product that has very few substitution options. So that's one thing that drives the demand. And the other thing is the fact that growing economies, the appearance of the middle class in emerging economies draws a lot of demand or a lot of steel from the market. So if we look at what China had in terms of increase over the past 5 years, and we compare it to the graph on the right, which is, let's say, the two biggest players in the iron ore industry, Australia and Brazil, you see that their exports increased, but it's marginal compared to the demand. There is a limit of supply in the market. There is different supply, and we'll touch base later, but high grade will be our main focus today, obviously. I think that the bottom right graph is very interesting to understand the dynamics of the market. If you look at the last boom or the last cycle with iron ore, the booming years saw investment significantly increase in the industry. But what happened after the collapse in iron ore pricing is a drastic reduction of investment in the industry. That's about 80% less in the last 5 years than what we had seen previously. And why is this so important? Well, you must be aware that developing a project, a greenfield project, or even a brownfield project in the iron ore takes a lot of time. It's probably in the mining industry one of the commodity where it takes the most time to put together a project. They're massive projects. They require enormous amounts of capital, permitting, social acceptance. Recently, we've seen issues in Australia. We've seen disasters in Brazil. All of these factor in, make iron ore project challenging to execute in some jurisdictions. So having so few investments in the past years will end up affecting the market. The big players decided to redistribute the money they had in hand to their shareholders through dividends, mainly in the past years. So that gap in investment will have an impact later on in the capacity of the market to bring new offer on the export market. So I thought it was important to highlight this aspect. Jumping to next slide. Well, what's the result of that situation with the market? Well, I think if we look at the graph, there's a lot of info to draw from that. The blue shaded area is the price of the index called the P62. So for those who are maybe less familiar with iron ore, P62 is the index of iron ore on the export market delivered to China that has a 62% Fe content. Let's call that middle grade, let's say. P65 is the high grade index, so it's the same principle, but for iron ore at 65% iron. And the black line is the premium that's captured between the two. If you look at the trends historically, high grade was mainly used by our customers to increase their productivity. That was driving a certain dynamic in the market. And made some fluctuations on the premium. But if you look at the last 2-3 years, and you can even go down 5 years, what we see trending now is that not only higher grade material impacts positively the productivity, it also drastically reduces the emissions of steel makers. So countries are putting together strict emission regulations. We see that globally in China. It's obvious. In Europe, it's there since many years. So that new imposition of strict measures for the environment makes the premium stay, and that's another reason for going with such a higher quality product. Of course, COVID has disrupted the market in the past months and in the past years, but you can see that the tendency is clear, and our view at Champion is that this will remain in the future. Moving on to the next slide. Well, obviously, if we account for our high-grade material, by trying to compare the cost curve with some other peers in the industry, we can see that Champion is well positioned again when it comes to cash cost. That might sound a bit surprising. Typically, people compare operating cost on an absolute basis, saying, okay, X company does $30 a ton and that other company is at 40. What's important to understand is that at the end of the day, customers buy for iron units. So if you want to compare apple with apples, you have to make sure that you account for these extra iron unit in the product that you sell. So in our case, selling a 66% concentrate has a great impact on the operating cost. So when we look at our position versus the majors, let's say, that are illustrated by these 4 white bands, we won't name them, but you probably have an idea who they are. We're in a very favorable position, and you can see that the high grade premium is some sort of a natural edge for Champion and for the high grade producers, as it positions us in a situation where if prices of iron ore would go down, as long as the premiums remain, they offset the extra costs that we have to account for, because we have to kind of process our material. Some projects globally are DSO projects, direct shipping ore. So they shovel directly in the mine and then go straight in the train. In our case, we have to do some processing that has a cost, but it's easily offsetted right now by the premium. So we thought it was important to mention. As far as results, we touched base earlier on in the presentation. Fiscal year 2021, despite COVID, was a great year for Champion. A record production of 8 million tons a year. If you recall, we have a nameplate capacity of 7.4. Looking at the top right chart, that's one that I especially like. If you look at our first year of operations, we were a bit shy of our nameplate, but we had to account for the ramp-up period. But still, we broke the site record, so we produced just shy of 7 million tons. The previous record on site was 5.8. So at our first year, we were already showing very good signs of performance. And then last year and the year before, we've exceeded our nameplate, which is typically uncommon in so few years. An EBITDA of 800 million, an earning per share of close to $1. We're actually trading close to $6 on the TSX. So I guess these results are very positive, but I think the key message here is, in order to benefit from these, let's say, positive periods of the market, we have to make sure we keep consistent operations, steady operations, that we control our pricing, and that's what we've been doing. If you look at our cash cost, it's stable. It's where we were expecting it to be when we did the feasibility study, and with the projects that are in the pipeline right now, our phase 2 that I'll describe a bit later on, this pricing will remain and for the future. Jumping to slide 10. At high level, maybe a corporate snapshot. Worth highlighting that right now we're net cash positive. So after our 3 years of operation, we had a bit more than 600 million of cash. If we look at the overall absolute numbers, 300 million cash positive. We have 200 million roughly of long-term debt. And we also have an available and undrawn credit facility of about $220 million that were intended to finance our phase 2 project that I'll describe a bit later on. Our shareholder base is also maybe a bit uncommon, but that's very positive. Management owns close to 11% of the company. Winchurch, which is a large fund from Chicago, owns 13%. Invest Quebec close to 9%, and family office account for about 20%. So roughly, we have a bit over 50% of our shares that are owned by supporters that have been with us for many years and that support our vision of growth. So it's an important aspect of our business, and you'll see why in the coming slides when we talk a bit more in depth about our growth trajectory. So what are these growth opportunities? Well, just to make it simple, right now we're under construction for our phase 2. What we call phase 2 is actually a mirror plant of the plant we operate right now. The intent is that phase 2 will double our production capacity to 15 million tons per year. That project was initiated by the previous owner. The previous owner had spent roughly 1.2 billion on what we call our phase 2 projects. Champion has to finalize the project, which is about 600 million, on which 170 were spent to date. Very important to highlight the fact that this project is de-risked. No surprise, you've seen in the industry major costs overruns on projects. It's fair to say that most of the time, some steps of a project are more prone to overruns. Civil work, concrete, structural work is typically where we see the highest risks. So in our case, and I'll show you later, most of it is done, if not all. So that's a de-risk project, and we'll talk about it later on. We also have a couple projects that are at this feasibility study stage. We'll talk about the Kami project a bit later on. Champion as the Fire Lake North project, which is also a project of a similar size on which we have a feasibility. And we have multiple assets that are under development, and we'll see later what they represent in terms of resources. But just so you understand that Champion, when you look at our organic growth, we have a pretty good sand yard to be able to play with all these resources and some different projects at varying stages of development. So let's start with phase 2. Well, as I said, the phase 2 project is approved, fully financed, and ongoing at the moment. Green light was given last November. We have about 250 workers at site at the moment. We're on track to complete the project by mid next year. And again, as I said, it's a project that has been de-risked mainly by the work that was done by the previous owner, but also by the way we approached the project in the last year or so, by starting with the remaining elements that were more at risk, and then moving on with completing the plan. So you can see, I know the pictures are a bit small, but the picture on the left is the plant. We're operating in Vermont. Vermont is known to have 2 seasons, this winter and last winter. Working inside is something that is very easy, let's say, compared to working outside in these conditions. So plant is closed. We have a heating system in place. You can see most of the equipment, the mill on the right, spirals are already in place. So that's a very favorable context, let's say, to execute a project. We've also ordered some long lead equipment or items. One that we show there is the stacker reclaimer that will be installed in Sept-Îles. So actually Sept-Îles is where we ship our materials from. So the material goes from Vermont by train all the way down to Sept-Îles to be loaded into Cape-size vessel and access the seaborne market. So that's for phase 2. Kami, some of you might know of the name Alderon, which was the previous owner of Kami. We finally have been able to put our hands on the Kami project after a couple of attempts. Kami is about 14 kilometers east from our Bloom Lake operation. It's in a region, again, that has been in operating mines for decades. So it's a greenfield project, but it's a greenfield project in an area where we already have a rail system, electricity, workforce, and all the suppliers in place that know mining. So it's probably one of the easiest, let's say, jurisdiction where you would want to develop a greenfield projects. There are other big projects in the pipeline or in the drawing books in the market. But when we think of projects that are in the middle of Africa or some other tougher jurisdictions, it's nothing to compare with what we have there, at least from my point of view. So Kami is 1.2 billion tons of resources. It's high-grade material. It's a similar geology than what we have at Bloom Lake, so we're in a known environment, let's say. This could be a project that brings more tons per year than the actual phase one. The previous study was for about 8 million tons. But what we're doing right now is to try and revisit the feasibility study to put it more in the champion fashion, and also to see how we can benefit from these synergies, being an operator in the region, which the previous owner was not. It's also important to understand this project has seen about $300 million worth of investment in the past years, mainly through drilling campaigns. They had ordered the main equipment, so they were at a quite advanced stage of their project. And we have been fortunate enough to acquire the projects for about, let's say, 10 cents in a dollar of what was invested over there. So very positive. We're very excited about that new acquisition, and we're looking forward to be able to disclose to markets the outcomes of our research and our studies. We're expecting that should be in line with the delivery of phase two, so somewhere mid next year. Product development is also an angle on which we put a lot of efforts. As I said earlier, what we do right now is a product that is at about 66% Fe. If you look at the bottom chart, all these black dots are different suppliers on the seaborne market, and the blue square is what we produce at the moment. So you can see we're already, let's say, in the top quality region of the market. Last year, we've produced 3 vessels to demonstrate their ability to tap in the direct reduction category, let's say. That's the blue triangle. And obviously, you see that once you get into that zone of what we call the DR quality material, there are very few competitors able to produce such a high-grade product. Why is DR material important, and why do you think we should be aiming at this niche product? Well, to start with, again, understanding that decarbonizing the steel industry will be a focus in the coming years. Well, in order to do that, using higher grade material is the simplest way to achieve some reduction in emissions, but also using scrap steel is obviously a good opportunity or a good option. But in order to be able to use scrap steel, you need to have an input of very high grade material, which is that material at over 67, 8, and even 69%. Also, direct reduction is a process that is cleaner for the environment than the typical sintering and blast furnace operations. And again, in order to do direct reduction, you need a very high purity material. So very few companies can compete in this market right now. Unfortunately, there are no, to my knowledge, easy ore bodies available with such high grades in the world. So this is why we put a lot of effort, and I'll show you later, on positioning Champion in that industry segment. And again, we spoke about a premium earlier on. The premium between 62 and 65 was right now close to $30. If you look at the chart, that's quite a big jump. But if you look at the amount of people that are on the right side of that blue square, you can imagine that this is going to attract premiums that are even more interesting, let's say, just by the fact that there's no offer on the market for this product. So again, we're pushing it a bit further, even more. We've been testing in the past year or so some different processes to get to a 69+% iron concentrate. What we will be using to do that is a mature technology. It's flotation, very common in some other sectors, especially with gold or some polymetallics. So it's a mature technology, and fortunately, it reacts very well with our material. So this is something that we're working on right now, and that could be a game changer for Champion. We've also been working on cold pelletizing. Just briefly, cold pelletizing is a technology that has been around for a couple decades. It's typically used by steelmakers to try and recover their dusts or their fines from the process, but they, for the most part, they don't have to ship it worldwide. So the strength of the pellets was not very important. But if we want to go on the seaborne market with cold pellets, it's important that they withstand, let's say, the impacts related to shipping. So we've been able to develop a cold pellet that is very, very close to the traditional pellets. We're still progressing on this front with our R&D team. And why we believe this is so important? Well, just to give you an example and a scale, using cold pellets instead of traditional pellets with our material would offset about 10 times the emission that we have on site. So working downstream in the steel making process for us is key and is where we should put most of the efforts. Not saying that what we do on the mine site is not important, but it accounts for 1% of the carbon footprint of a ton of steel. So obviously, we'll do everything we can to reduce our impact at the mine site, but we think that we must invest also in the downstream or Scope 3 processes. So that's about it. I think on time I'm quite good, and it'll be a pleasure to answer your questions about the presentation.
Alexandre, thank you so much for the presentation. I look forward to hearing your thoughts on the questions. We have quite a list coming in from the audience. So for Michael and Alexandre, I'll just start to read off some of the top questions that have come in, and thank you for that. First out of the gate, speaking of the Kami project, although the new Kami feasibility study is roughly 1 year away from completion, are there any initial challenges envisioned with potentially incorporating Kami with the Bloom Lake operations?
That's a good one, Mark. Well, as I said, Kami was pretty well advanced. The thing with Kami is it's about 10 kilometers away from our railway. So Champion owns a 30-kilometer railway linking the Bloom Lake asset to the QNSNL railway. Mm-hmm. There is, and you might have seen in the news, Labrador has a big hydroelectricity project coming in line. Muskrat Falls, they have plenty of electricity and they're looking for customers, so we would be for sure one of interest. We also have access to a workforce that can be shared with Bloom Lake. There's a whole basin of also experienced workforce in the Lab City and Wabush area. Suppliers are already in there. We own a lot of capacity at the port of Sept-Îles, so obviously this is another synergy that we can benefit from. At the time, the previous owner had to build a lot of infrastructure, port infrastructures, which was costly. In our case, most of them are already in place. So I could go on for a while, but to me, it's not saying it's an easy task, because we really want the Kami project to look alike what we Champion like to do. But I think maybe Michael, if you want to jump in and fill the gaps, but.
No, I think you've answered quite a few of the key elements, but what I think is a major differentiating factor for the Kami project when we look globally for any iron ore project, and especially in high grade, there is very little available infrastructure in the world. And we benefit here in Quebec from massive investment being done in the previous cycle by governments to expand a lot of the infrastructure. In fact, the governments continue to expand infrastructure at the port currently to continue and increase the overall capacity of the port to hopefully match the berth that was built several years ago. But when we look globally, I mean, this is a project of major scale that benefits from infrastructure, and that's very rare in the world.
Beautiful. Great overview. Thank you both. Another question here in terms of competition. Can you discuss the high-grade market competition?
Another good one. I think I'll let Michael on this one. He's so passionate about it when he... So let's go ahead, Michael.
I mean, maybe take a step back. So iron ore is a very interesting industry. Arguably, it's the best oligopoly in the world. It's controlled by 4 publicly listed rational companies that together, the big 4, control nearly 80% of the global seaborne market. So that creates an environment where they're very rational in the way that they operate and bring on new projects typically. But more importantly, the high-grade market is effectively a monopoly. And that's very interesting because that monopoly is effectively Brazil. And it has now had a few issues in the past to bring on supply on a constant and reliable basis. And that happens exactly at the time, while I'm sure you have the same thing in your inbox every Monday morning, there's more and more chatter and rhetoric around emission control in the world and reducing emissions. And like Alexandre said just earlier, there's a major push by governments to reduce emissions, not only in their economies, but in particular in the steel industry. So that creates more demand for high grade. So the concentration of current production coming in from Brazil and the massive demand pool that's being created for high grade globally really sets an opportunity for a company like Champion because Quebec is the second largest export hub of high grade, like Alexandre said. But here we are, a company after just a few short years. We've accumulated a significant portfolio of asset. We have available infrastructure, and we can deploy our wings within that market and create a niche for ourselves. We do feel the demand is here, and we do feel there's an opportunity for us to fill it.
Terrific. Thank you very much for that. Let's move over to the sales realm. There's a question here asking about just in terms of sales to the US and the EU, curious about selling product there versus not selling product there. What's the current status with the company?
Well, I think in the past years, in only 3 years, in fact, we've developed quite a large customer base. We have over 20 customers worldwide at the moment. Obviously, we're really involved into China, Japan. If we compare though with some other peers, our exposure to China is relatively low. Our interest in the EU and US markets are for sure on the table. Obviously, you can consider that shipping is one of our major costs. So tapping into markets that are closer to Quebec is obviously a good way to reduce our costs. But yeah, I think one other key element with the United States and Europe is that they have the stricter rules when it comes to emissions. Okay. So if you look at what Europe does, Europe consumes high-grade pellets. Europe is shifting to electric arc furnace. It's if we looked at the available United States market, it's also occupied mainly by a player in the EAF market. So of course that's an interest. We keep on developing our customer base and are for sure interested in going into these markets. Okay,
thank you for that. Another question here: what is the corporate strategy on capital allocation in terms of dividend, leverage, and growth?
Michael, I think I'll let you go on this one and then maybe just complete.
Sure, yeah. If you want to come in, Alex. I think when we look at that, it's important to highlight again what Alexandre said. Management controls nearly 11% of the business, and every action that we take is in line to try to maximize the corporate value. And the first day that we stepped in by acquiring Bloom, every action that we've taken has been to do things on a conservative basis, to do things diligently, and to do things so that we can benefit from the decades of available resources that's in front of us, and deploy our vision of what's now playing out, which is the high grade market. Short term, there's no doubt, right? Completing the phase 2 project, I mean, we benefit from $1.2 billion US that our predecessor left behind. We effectively just complete the project. This is a global scale project, so for us, that next dollar is unmatched. It needs to be spent on phase 2. As we complete phase 2, like Alexandre said, we want to align as much information in front of you to provide consideration for organic growth. And this is going to be a great time for us to take a step back and see where we are, where the market's at, where our balance sheet shakes out, and see the right approach of growth versus do we approach our board of directors to implement a redistribution strategy. But one thing that's quite phenomenal is after 3 short years, after deploying so much capital here to make structural changes at the mine, we're already net cash positive. Just as of last quarter, we had over $330 million in net cash, and that's a very powerful position to be in, especially as we enjoy the structural shift that we're seeing in the high grade market.
Okay. Maybe I can just add, because I think I skipped it in the presentation, but Champion has a portfolio of about 7 billion tons of high-grade material if you account for all of our properties. Just to put that in perspective, if you've heard of the Simandou project, which is probably now close to 15 billion, what's expected at least to invest, that's about 4. So there are a lot of opportunities out there. We'll see once phase 2 sets down how we move on, but lots of possibilities for Champion, let's say, moving forward.
Great, thank you. Impressive numbers. Question about emissions has come up here. Can you discuss the emission reduction potential and pricing potential of other products being considered? For example, 68%, 69% in cooled pellets.
Yeah, that's a good one and of interest. Of course, if you recall what I said earlier, the industry is moving to electric arc furnace. It's moving to more use of scrap steel. And if you look at the carbon footprint of 1 ton of steel, I'll go back again, but 1% is, in our case, at least 1% of the emissions is tied to the mine operation.
Okay.
90% of the rest of the emissions is the way we agglomerate the product, the way we transform it into metallic Fe. So by moving into cleaner processes to produce steel, the reductions will be drastic. But in order to get there, there is a need for high purity iron. What we see globally, especially in Australia, it's also true elsewhere, is that ore bodies are declining in qualities. Obviously, the good stuff has been mined in the past years, and that's how things are. And it's also very difficult to transition from a direct shipping operation to an operation similar to the one at Blue Lake, where we have to separate and clean the material. This requires water, and this requires, obviously, infrastructure. So we see that in the near future, the impact will be drastic for those who will trend and get to that pathway of using these new direct reduction and electric arc furnaces technology. And I don't know, Michael, if you want to add.
Yeah, I mean, I think you're absolutely right. Champion and its product, we have a major opportunity to help the world decarbonize. Every ton of iron that comes out of our land really is a major contributor to help reduce emissions. But with regard to our pricing and how that translates, into our potential operating margins, like Alexandre said, we price our current iron ore concentrate from the high grade index. And now we've proven our ability to do an even higher product, which is a direct reduction, 68%. You're really entering into a niche market here. So there's no index for this at this point. But we can capture a few extra dollars net margin when we account for the additional costs it gets us to transform that product and what we get from it. Now, if we get that product from, again, the current 66% to 68%, which we're already proving commercially, to potentially a 69, that extra percent doesn't seem like a lot, but you're really changing gears here because you can really capture potentially a substantially higher premium, we believe, over time. Mm-hmm. But as the world transitions towards the electric arc, there's simply not enough scrap in the world to allow a transition to electric arcs to supply sufficient steel for the world.
Okay.
So we feel that type of iron, which can be a substitute for scrap, can start to price substantially higher. And some analysts are now starting to discuss that type of product, or at least a conversion of that product, can trade in tandem with scrap. And if that happens, you're starting to talk about a completely disconnect from current iron ore indices we use, and that would really be a substantial contributor to our margin. So we're doing product testing here, but our vision in the future is definitely for a decarbonizing world, and that's the way that most analysts believe transition needs to occur, is through the electric arc, and we can participate in that.
Beautiful, thank you. Interesting that 68 to 69% doesn't sound like a lot, but it actually is. So I appreciate that, absolutely. A question here, Alexandre, off the top, you spoke about COVID in Quebec and where the numbers were and how that impacted process. We have a question here. Any comment on the potential impact of COVID on Brazilian production?
Well, obviously, if you follow the news in Brazil, it's been very tough. Honestly, I think it had some impacts, but I know there are so many other things that can have an influence on what Brazil does as far as outputs of iron ore. It doesn't take much to make big numbers. If you look at the scale they operate, a fire on a conveyor belt, a bad couple days of rain can have massive impacts on the market. Michael, are you aware of numbers that are directly tied to COVID when it comes to Brazil, or?
Yeah, I don't think there's anything specific to COVID. I mean, it's quite unfortunate, that they're still, very much at the top of the wave, I guess. They're also entering into their winter season, which, as we know, has not been easy for our winter season in the Northern Hemisphere.
Right.
Very difficult to know how that's going to impact, but Brazil continues to lick their wounds after a few dam breaks, at least 2 dam breaks in the last few years. That's impacted the supply chain there. That's impacted permitting timeframe. I mean, it's difficult for us to comment on what's happening really in Brazil. For us, what really matters is, we continue, and I think the way we've set up the laboratory at site very early on, we were one of the first companies to do so. Really speaks in the way that we manage the business, always very diligent and try to be as conservative as possible. And with regards to COVID, we're not letting our guards down. All of our measures remain in place, with the lab really enabling us to screen things very quickly and control events when there's any, to make sure there's no outbreak.
I appreciate that very much. We have a great overarching question, which is, can you please comment on the current iron ore market, and in particular the trend towards the higher grade premiums?
I think we've touched base a bit on that, but really, again, I mean, everything that's high grade, to me, the way to see it is, if you get back to that slide where we show, where we're at in the market, we move towards the right in the high grade and very high grade sectors. I mean, then you're in a niche market, and I think that's where we want to be in. We want to stay as far as possible away from that oligopoly that Michael described. Obviously, we're fractions of percents when we look at our impact in this market. So really, we want to be in a game where Champion is a major player collecting major premiums for its products.
I would add on to something, if you don't mind, Alex. If you have to take a step back kind of on generational situation, right? For the last 30 years, China was really on a big, major plan to urbanize the country and to create their own economies, right? And they did so and really building quickly. I think we all remember in the early 2000s when they started building ghost towns every week, and we didn't really know what the hell they were doing, but those ghost towns are full now. But the same thing happened at one point with the US and Europe. These economies go from emerging into developing and then into mature economies. And as they do so, typically they have very little emission control. And that's really what happened over the last 30 years. You saw China really consume a lot of low-grade iron ore to really serve the purpose to build an economy. Now they're turning the road, and they're turning quickly. I mean, they put in their 5-year plan in March. They want to stop producing emissions for the benefit of other countries. And they said very specifically that they want to target some industries, including steel. So what is happening here is, they want to stop using low quality product, and they want to stop manufacturing products to create emissions for other countries. And that's a big impact in the way the global economy can source steel going forward, because if China doesn't make a bar of steel, somebody else needs to make it. But these other countries that have spare capacity, namely Europe, Japan, the US, they have much higher emission controls than China does. So every ton of steel that's not made in China, that going forward will need to be made elsewhere, if that Chinese plan does roll out, will have a massive impact on the supply chain of iron ore that will need to secure more high grade. And we feel that recent trend that we've been seeing on the high grade premium is really just reflecting the beginning of that story.
Fair enough. That's a great throwback to the old supply-demand basic foundational teaching. I appreciate that. We have a couple moments left, so we'll try to get to one or two more. Gilles asks, given the fierce competition for docking space and loading equipment at the port of Sept-Îles, Champion seems to be struggling to load 12 ships per quarter. Will Champion be in a position to ship its full production when the capacity is doubled on completion of phase 2?
Yeah, okay, an interesting question. I don't know that we're struggling to load vessels, but one thing that is important to highlight, the new berth facility in Sept-Îles was commissioned effectively by Champion. We were the first user to operate this brand new state-of-the-art facility. This facility has about 50 million tons of capacity. If we look at the railway, the QNSNL railway has plenty of spare capacity. Right now, we're investing about 135 millions at the port of Sept-Îles, like the set-down area. The government has committed 180 million on top of that, so that's more than 300 millions that will have been invested by the end of next year. Everything is falling into place to be able to provide an output way to this material. So no concern from my point of view.
Wonderful. I appreciate that. It's a positive outlook, and both of you have shared quite openly and beautifully in terms of the company direction, where things are going. I will encourage our viewers once again to fill out a questionnaire so we can improve our experience moving forward. And Alexandra and Michael, thank you very much for your time today. We look forward to watching the company move forward.